Okay, so I think we're going to pretty quickly go through the employees' retirement here. Sorry for getting this kicked off pretty late. So, Doreen, we'll call the meeting to order at 7:01. And so we've got to approve the minutes from the regular March 22nd, 2023 meeting. Yep, exactly. And there are two corrections on this. One was Molly D'Amico was listed as Molly Dam, and so that needs to be corrected. And then the other one was Elizabeth Noble. Looks like there was just a misspelling of her last name. So unless anyone wants to have a discussion about this, then if I could have a motion to move forward.
I'll make a motion to.
Okay, Eric, there's one. A second. Do I hear a second on that?
Second.
Okay, Chris will second. All in favor of approving the minutes with the corrections, the two corrections that were just mentioned, say aye.
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 Any opposed? Okay, any opposed? Any abstain? Okay, very good. Now we have 3 regular retirements. One is or 2 are for the Board of Ed and one is a town employee. All 3 are normal retirements. Doreen had sent out the paperwork earlier. Does anyone need time to read through those or any discussion needed on these? Okay, could I have a motion to approve all 3 at one time?
I'll make a motion to approve all 3.
Eric is one. Do I have a second?
Second.
Okay, second with Chris. All in favor? Aye.
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 Any opposed? None. Abstain? None. Okay. Let's see.
Megan was going to go, she said she just was going to say a few words about the administrative update
Okay.
here and then go over.
Okay, very good. So Megan, we'll turn it over to you for the administrative update.
Sure. I thought we could add to the agenda going forward for meetings as an administrative update to give the board an idea of what things are happening in the plan and how the implementation with Milliman is going. So I'll go in a bit of detail at the JRIB meeting. If there's anything that's specific to just the town plan, because the town plan is a closed plan that isn't relevant to both plans, I would bring it up in this meeting and not include the JRIB meeting on those administrative items.
Okay.
So Jack, just to be clear, this is still employees?
Yeah, this is employees. This is employees. Okay, Megan, anything else?
That's it.
Okay, can I have a motion to adjourn?
Make a motion to adjourn.
Okay, second?
Yep.
Chris, all right, very good. Meeting's adjourned.
And it is 7:04.
7:04. All right, we'll move
Carolyn,
right
Russ
into.
is on.
What's that?
Russ Atkins is on.
Okay,
I don't
Russ,
want to cut in the
great.
middle of people talk. Sorry.
Yep, no problem at all. Okay, let's see. It is 7:04, and we'll call the JRIB meeting to order. Let's see, I lost my
Agenda?
Oh, I've got it right here. Okay, so I think the first item is on the agenda, there's been a request to move the administrative report up. So unless there's any discussion for that, which I'm doubting whether there is, I need a motion to move that. So if I could have
Make a motion.
motion, Eric? Yeah, Tom seconds that. Okay, all in favor of moving the administrative report to just below the minutes? Could I have aye?
Aye.
Aye. Any opposed? No. Any abstain? Okay, motion passes. We will move the agenda to after the minutes. And then we've got the regular minutes from last month, which were also sent out. Did everyone get those meeting minutes? Okay. Does anyone do we need time to read through it, or is everyone good to move forward? Looks like we can probably move forward. Could Could I have a motion to approve the minutes from the JRIB meeting from March 22nd?
I'll make a motion to
Okay,
approve.
Second.
Eric, Tom will second. All in favor? Aye.
Aye.
Any opposed? Any abstain? Okay, motion carries. Which brings us now to the administrative report. So back to you, Megan.
Thank you. So just a quick update on how the plan is going and the items of note that have been brought to the front over the last month or so. The Milliman implementation, we're pending a final draft of the Town of Fairfield Employees Retirement System Plan document from Richard Cohen. We're nearly finalized on that. The go live for the town plan has been revised to October 1st, 2023. We were hoping for a July 1st implementation date, but we've come across some hurdles and we want to make sure that it's right when we go live. So we're looking at October 1st now. Once we are in a good place with the town plan, we'll begin working on the police and fire plan. We're pending a first draft from Richard Cohen on the police and firefighters retirement system plan document, because all our focus is really on the town plan right now, getting that implemented, then we'll move to the police and fire. So we have not had a kickoff for police and fire yet. That will be to be determined with Milliman.
Has Milliman more or less stayed on schedule?
Yes, it's nothing that Milliman has fallen behind on. It's really the items that we're finding that we want to clean up before we move everything over to Milliman. So as we're discovering things that may need more research or may need to be corrected, those are slowing us down in getting the implementation on track, but we really want it to be right. So we're taking our time to investigate everything that needs to be investigated.
Okay, great.
Megan, is there a process for how this is going to be disseminated to the various bargaining units and the independents and that kind of thing? Just curious as to what that is, and if there's will there be a period before the go live where any questions or problems that those either bargaining units or those individuals within those bargaining units can talk to you guys before that goes live?
Yes, so our plan, once we have the final draft from Richard for the town plan, is to meet with each of the unions to go over the final revised plan document. Nothing has changed. It's really just solidified in further detail, because the 1987, I think it is, document that we have is very vague on a lot of points. So we've just spent time trying to really codify how the plan has been running and what the rules are. If the collective bargaining agreement of the unions has something different than the plan document, what's in their collective bargaining agreement trumps the plan document. But if they're silent, then the plan document rules. So there will be a meeting with the unions.
I just want to know that there is a contingent. I don't know if it's on the town side, but on the BOE side, there is, I don't know, 15, 20, 30 independents. So I don't know how they're gonna be represented in this process.
Yes, that's a good point. They were one of our discoveries, that there is no guiding document for them. So they defer to the plan document. But even with like elected officials on the town side, there's like a salary and compensation guidelines document, and pension is specified in that document. But for those BOE people, those like
I'm one of them.
Oh,
I'm
okay.
in that group. I'm in that group.
Okay, so there's no guiding document that's been able to help me identify anything specific. So for your group, we've been putting in the plan rules. So what's in that 1987 document, and then what's in the more specific revised plan document.
Okay, fantastic. All right, again, if there's any communication that you need on the BOE side, either to the unions or to the independents, I could be a point of contact for that.
So is independence or support staff, what is the preferred term for that group of people?
We've always been referred to as kind of independents. That's what I've always heard. I didn't make that term, but that's what the term that was kind of preceded me. So, I think it's like the IT staff and
Yep.
certain like
HR.
certain assistants, and they're not secretaries, but they're like kind of executive assistants and that kind of thing, and some HR people. Yeah, I mean it's a handful of us.
Okay, thank you. That's helpful. Okay, any other questions or comments on Milliman? Okay, so I'll move on to one of the items that we discovered during the valuation was an error with the 7/1/2022 cost of living adjustment. There are 20 participants that got the wrong factor applied to their COLA. So they had the 2-year factor applied to their annual COLA. So they got almost twice as much as they should have been getting from July 1st through April 1st. We sent out letters notifying people that we were going to be correcting this for April 1st and recouping the funds in May. We gave people the option to contact me if they wanted to set up a payment plan. 6 out of the 20 participants set up a payment plan. So we'll be recouping over the next between 3 and 9 months for those participants who elected it. So everything will be corrected by January of 2024. The town, JRIB, Carolyn and Eric requested that the town pay for the interest on this, the lost interest on the overpayments, and that amount was about $560. So I'm working with Jared on how we're going to get the town to repay the pension plan for that interest.
Megan, just as a general rule, I mean, when you say that you got double, I mean, it wasn't a huge burden on a lot of these people that they have to pay back, is it? I mean, I don't know what kind of money we're talking about. Is it, the average is $1,000 per person, or is it 5,000? I don't know.
No, it's less than that.
Okay.
So the highest I think was about 1,000.
Okay.
Yes. I heard from the 6 people. The rest of the participants didn't comment. I think they understood that an error had been made, an unfortunate error, and that we were taking steps to correct it. Okay, another item that has come up through the Milliman implementation was after-tax contributions. So even though we're not on police and fire yet with Milliman, I started talking about the contributions that participants had made. The town plan, participants all make contributions now on a pre-tax basis. Police and fire make contributions on an after-tax basis. And there's something called basis calculations that need to be done on the after-tax dollars so that when participants retire and go into pay, they don't pay taxes on those after-tax contributions because they'd be paying taxes on them twice. So it looked inconsistent to me how the after-tax contributions had been treated. So I went back to recent retirements back to 2019 and found 24 retirees that had made after-tax contributions that were not having a portion of their pension on an after-tax basis, like that they're not taxed on. So we sent an on-notice letter to those people trying to communicate what these basis calculations are. It's very confusing, and it's not going to affect people's bottom line pay. It just affects the taxation. So I've completed doing all the basis calculations, and I'm ready to send out a specific letter to each participant, letting them know what the after-tax portion or non-taxable portion of their payment will be starting on June 1st. So there were 2 town participants, 11 firefighters, and 11 police officers that were affected.
Is that it, Megan?
That's it.
Sorry, just one more thing, Megan. I appreciate all your effort and diligence to kind of get this done, and I'm glad we're kind of down that road because I think we're trying to covering a lot of stuff. Do you envision any kind of other kind of stuff like that popping up, or is that the kind of stuff you're still kind of dealing with right now as you're finding these little things here and there that may not have done correctly or incorrectly and that kind of thing?
I think the things we're going to find now are one-off things where somebody had an incorrect calculation because of a break in service or a leave of absence or something like that. I am hopeful that we're not going to find other wide spanning errors like this, and working closely with Milliman on the valuation. I just got out all the pension statements. So working on the pension statements as well, identified some people who had terminated and didn't get notified as a vested term, what their options are. So now I can reach out to those people. So I think it's going to be less and less. and it's just going to affect 1 and 2 people, not a big 20 group, a group of 20 people like these things.
Great. Thank you, Megan. Thank you for your efforts. I think this is something that, everyone will benefit from for having this kind of, great going, really worked out going forward. So appreciate it. Thank you.
Great. Thank you. I will drop off the call.
Great job. Thank you. Thanks
Thank
for the
you.
update. Okay, with that, we will turn it over to you, Brian.
Okay, great. And Doreen or others, we have 2 presentations before we get started. Is there a way to bring it up on the screen, or does everyone have it individually
Do you,
to follow along?
we can bring it up here, right? Is it-
We can share.
The one that says Harbor Vest in it first.
Here's
Yeah.
Barbara, yeah.
There you go.
Yeah, great. So as we're pulling that presentation up on the screen for everyone to see, let me first start by introducing my colleague who's on the line, Matthew Schweitzer. He is part of the team that leads our efforts on any manager research with our alternative investments, and Matt's been heavily involved with the selection and monitoring and daily, these days, interaction with HarborVest. So we could aim to have HarborVest in later this year. We just had a conflict for today, but without having nothing, we wanted to have we touch base with Carolyn, have Matt just give an update on where the funds are so far. The biggest one being the 2021 fund because one more into its process. So Matt will give an update on the HarborVest fund that town is invested in, but also just an update on the firm and what's happening as well. As we always do, even with my presentations, please address any and all questions. This is a Q&A. It's for the benefit of the whole JRIB, so I think it's an open mic for everyone. So Matt, with that, why don't I turn it over to you, and we have the presentation up online.
Great. Thanks for that, Brian. And good evening, everyone. Pleasure to be with you here tonight. As Brian stated, my name is Matt Schweitzer. I'm a senior product manager where I help lead manager oversight and product strategy for Vanguard's private equity offer through HarborVest. I thought we'd kick off today's discussion with a quick overview of your capital account summary. From there, we'll dovetail to the portfolio, take a look underneath the hood a bit, talk about deal pacing, some of the investment trends and themes that we're seeing in the underlying investments. And then lastly, we'll wrap up the discussion with just a broad overview of some of the themes we're seeing across the private equity market and landscape. So that was today's agenda. Certainly encourage questions, dialogue throughout. So feel free to raise those as we kind of proceed through the presentation. And so with that said, maybe we'll kick off the discussion here on page 4. And this page is your capital account statement, just a snapshot of your account balances as of December 31st. As you kind of progress from left to right, you can see your commitments to both the 2021 as well as the 2022 vintages. Total paid-in capital for those funds as of this time of $875,000, and that is relative to a total net asset value or NAV, as you see on the right, of $900,000 approximately. I would say most positions at this time, especially in the 2022 portfolio, still being held at cost, as evidenced by the total value to contributed ratio, or TV/C, that you see here of 1.0x. But we have seen some nice appreciation in a few of the secondary deals thus far that have been closed, and we can certainly provide more color on that here in just a bit. One thing I would emphasize is that since this is a 10+ year investment, performance really won't become that meaningful until a number of years into the fund term, roughly around year 5. I think that's when you'll start to see the portfolio transition from really its investing phase to its developing phase in the life cycle. That's when the primary investments should really start to take hold and become just a more meaningful driver of long-term returns. But really, what is important, I think, in the early years of the funds is a few things. Number one is investment pacing. So, key question there is HarborVest on track in terms of deploying capital, committing to deals across the various strategies? And then secondly, is manager and deal quality. So is HarborVest securing allocations to oversubscribed opportunities, high quality deals in secondaries and co-invests? Usually that's a good leading indicator for performance longer term. And so, the short answer to both of those questions at this very early stage is yes. And those are questions that I'll seek to address in more detail as we kind of navigate, throughout the presentation here this evening. Maybe proceeding here to page 5. Not going to spend a whole lot of time here. This is just a quick overview of the strategy. We intentionally designed this as a turnkey private equity solution. It is providing, comprehensive exposure across the spectrum to primary partnerships, secondaries, direct co-investments. We're also diversifying that across buyout and venture capital within global geographic markets. A very elegant solution. We created this to solve for many of the challenges that investors face when investing in PE, namely scale, diversification and manager access. And you can see the various target allocation percentages here at the bottom of the page. Here on page 6, as we kind of dovetail here, on this page, this is where I would really like to spend most of the time talking about the portfolio, some of the themes that we're starting to see emerge in the underlying investments. And, I'm going to focus most of the conversation on the 2021 fund, if I may, just because that's the more mature vintage at this stage and where, just a lot of the capital has been deployed thus far. And so if I may orient the group to the top left part of this chart, you'll see that about 1% of the fund has been called thus far, but that's scheduled to change pretty soon. So starting in May, we anticipate there will be a capital call, at a semi-annual frequency, with the amount of that call ranging from 6 to 10% of committed capital. I think that's going to be about 8% here upcoming in May, but in any event, we'll be issuing a distribution notice at least 10 days in advance of that. But that's all to say that deployment, the calling of capital is scheduled to, gradually increase here over the near term and on a go-forward basis. One thing, one question I mentioned earlier is, one thing that you should be thinking about at this very early stage in the fund is, whether the portfolio continues to be on track with its investment pacing. And so if I can, focus the attention on the section below these dark blue boxes where it shows primary, secondary, and direct co-investments, you'll see just the breakout across those 3 strategies, the amounts that have been committed thus far to each. I'm pleased to inform the group that HarborVest did end 2022 ahead of schedule with their deal pacing. You do see September numbers here, so this is as of 9/30, but as of the end of March, they had committed roughly $360 million to deals versus a total fund size of $568. So that should put the fund on track to have LP capital fully committed sometime in the first half of next year. And that's when that 3-year commitment period should come to its conclusion. So again, I think the punchline here is pacing continues to proceed according to plan, and we're really pleased by the progress HarborVest has made, especially in light of current market conditions. Focusing a little bit more here on the primaries, so you'll see that it comprise roughly 60% of the portfolio. The allocation right now is diversified across 26 underlying partnerships. I think a key question here is, what level of manager quality are we seeing? Answer to that is, we really are pleased with the roster that has been assembled from top to bottom within that primary sleeve. We're seeing HarborVest has received full allocation on all 26 of those opportunities, so they're getting their full ask when they are getting access. In all 26 of those opportunities were oversubscribed offerings at the time of closing. Some flagship names in that allocation, whether it be Thoma Bravo, Bain Capital, Kleiner Perkins, just to name a few. Within direct co-investments, you know, that allocation as it stands currently diversified across 15 portfolio companies. You know, these are deals focused on very resilient businesses, diversified across technology, healthcare, consumer. We do have 3 more deals in the pipeline, and it's anticipated that once those 3 deals are completed, that allocation will come to a close. And then lastly, within secondaries, like co-investments, similar to co-investments, comprise of 16 underlying deals. And if you take a look at those investments, they really run the spectrum. You have everything from, you know, a very highly diversified deal where, you know, you're seeing that comprised of 100 underlying partnerships, over 1,800 individual portfolio companies, to, you know, a deal that's, you know, a single asset continuation fund. So just, you know, a very highly diverse portfolio with strong managers. The performance on the secondaries allocation as of 9/30 is currently marked at 1.3x, and so that's helped drive some of the early performance in the fund, and we'd expect that to, you know, continue in the coming years until primaries really take hold. Real quick here on portfolio construction, you'll see it's diversified across the U.S., about 75% U.S., the remaining portion across Europe, as well as Asia Pacific, and then within stage, call it 80% buyout, 20% venture, and that will be diversified across small, mid, and large buyouts, and then within venture capital, seed, early, as well as late stage. Maybe I'll just maybe pause here and ask, you know, if there are any questions thus far regarding any of the content that I've covered thus far.
I got a question. When they have an investment committee overall at the organization, HarborVest, right? So going through a lot of deals, they're screening it down. How do you determine this fund gets it versus a non-Vanguard HarborVest fund, right? Or are they slicing it up?
Yeah, thank you for the question. So that's a process that is firmly governed from the very top of the firm at HarborVest. So HarborVest has a committee. It's called the Portfolio Construction Committee, and it is chaired by their co-CEOs, John Toomey and Pete Wilson. And, you know, essentially what that Portfolio Construction Committee is charged with is, you know, once the investment committee approves, you know, a primary investment or a secondary or a direct co-investment deal, that deal goes to the PCC. And it's really at that level that, you know, they look kind of HarborVest looks across, you know, both the Vanguard strategies as well as the non-Vanguard strategies to see where, you know, that deal is appropriate. And, you know, this is a process that is audited each year, and allocation decisions are really made on a pro rata basis across, you know, all HarborVest active strategies to make sure that that allocation is both fair and equitable to all their LPs. So in short, you know, it is a process that's, again, governed at the very highest levels of the firm, and one that is really at its core, you know, done to ensure fairness and equity in that.
A related question, if you don't mind. Could you tell us how, and sorry if this has been covered already elsewhere, but how large is the Vanguard component within HarborVest, and how long is that relationship?
Sure. So we first launched our partnership with HarborVest back in 2020. So we are now in the process of raising our 4th vintage with the firm. And so as it stands today, we have roughly $1.3 billion in committed capital to the 3 live vintages, soon to be 4th. And I think at last note, the total AUM at HarborVest was approximately 100 billion. So we're probably a little over 1% at this point in time, but you know, certainly a growing portion of their LP base.
Thank you.
And then again, Tom, on this particular slide that's up for the 2021 fund, you could see the total fund size up, that 568 for the 2021 fund in the top left corner.
Top left corner.
Yeah.
Mm-hmm.
So Matt, is there a similar fund to this 2021 vintage that's probably not 568 million, that's, you know, a non-Vanguard HarborVest fund that's quite a bit larger, but has got the same risk profile?
Yeah, there actually is a similar non-Vanguard HarborVest strategy as this one. It's the HarborVest Global Fund program, and I think they launched that strategy back in 2013, 2014. So that's relatively new. And again, it's very similar to the Vanguard HarborVest funds in terms of stage, strategy, and geographic allocation. Really meant to be a core holding for, you know, an investor's private equity portfolio. I would say one fundamental difference between that strategy and this one is that, you know, in the global fund, you're going to see small allocations to areas such as private debt, real assets, whereas our solution is pure private equity. And so that was intentional on our part. Our belief is the most firm. We have the highest conviction in private equity as an asset class versus, you know, some of those other areas. It also makes it more straightforward from a portfolio construction standpoint as well when we're constructing portfolios for our advised clients. So that was an intentional on our part, but you know, by and large, pretty similar.
And you said that was 2014, around there?
Yeah, that was launched in 2014. I think since then they've launched a new vintage of that each year. Maybe they've skipped a year here and there, but there's a number of, you know, the Global Fund is a you know, an active program within HarborVest.
I just have one more question. Are there constraints that HarborVest puts on the Vanguard funds with regard to the size? I mean, 568 is tiny to Vanguard and tiny to HarborVest. How'd you guys come up with that number? Would it have been larger had you been able to get more assets into the fund?
Yeah, you know, the fund size is really just determined by how successful we've been or we were able to be at fundraising. And so, you know, today we offer this product in our institutional advisory business to clients like the town of Fairfield. We also offer it in our retail ultra high net worth channel as well to both advised and self-directed clients who are qualified purchasers. So the fund size will be just largely determined in terms of how, you know, successful we were at fundraising for that given year across those various cohorts.
I think that's a key part, is it's not open to all of Vanguard.
Yeah,
and,
clearly.
You know, it's really, the first offering was only made available to OCIO clients, institutional clients, for which we give advice, not any institutional client. And then, as Matt mentioned, the ultra high net worth segment within the personal advisor space. So limited, and then each year the fund size has been growing.
Any other
These are all
questions?
great questions, so please continue if there's anyone on the phone as well.
No, it's back to you, Matt.
Great, thank you. So I thought we'd maybe conclude the discussion today with just kind of providing a broad market overview for the group. Take a look at some of the themes that we're seeing out there in the broader private markets landscape. And we'll center that discussion here on perhaps page 16. Just give a minute here to forward. And there we go. So this provides a good snapshot of, just kind of this current state of things in the private markets, looking across, fundraising, deal activity, as well as exits. And I think if you look at all three of these charts, you definitely saw a pullback from 2021 levels, but by and large, the level of activity last year was still in line with pre-COVID levels, with the exception probably of exit activity. And so I'll want to take these kind of a little bit one by one, maybe focus on some themes. I think if one theme that we're seeing today that I think really epitomizes the state of things in the private markets is this idea of flight to quality. And I think flight to quality applies really on multiple levels. First, focusing here on fundraising, many large LPs, you're seeing them concentrate their commitments, concentrate their bets on their most high conviction and most proven managers, largely due to the macro uncertainty that we see, existing today in the market. And I think if you take a step back and think about how HarborVest has implemented that and applied that to the portfolio today, taking a look at the primary managers and the primary funds in the program, over 70% of that capital has been committed to primary funds where HarborVest has at least a 10-year relationship with that firm. Okay, so uncertain market, now is the time to really, again, kind of tailor your approach and go with your most high conviction managers who have that proven track record, who have shown an ability to drive value and create value in a 3 to 5 year period, regardless of where we are in the market cycle. And so this is just going to be a really tough fundraising environment if you're a new or an emerging manager, and we're likely to see some consolidation there as a result. I would say on the deal side, taking a look at deal activity, investment activity toward the right, what we're seeing is the assets that are coming to market and the deals that are getting done usually are involving only A minus, A plus rated assets. And those deals have become more competitive. We're seeing a lot of managers, HarborVest is seeing a lot of managers holding back their B rated assets, waiting for the exit conditions to improve. And if you look at some of the co-investment deals that have been done within the portfolio, really high asset quality and resilience have been really at the forefront and at the core of some of those deals. Maybe dovetailing here a little bit and taking a look at exits. I think if you look at the chart on exits, you could very clearly see that 2021 was a pretty euphoric year in terms of activity, and the liquidity that was able to generate for investors in private equity. A lot of that was probably activity that would have occurred in 2022, but that was pulled forward into 2021. But what we're really seeing now is many large limited partners, investors out there in the market, having challenges freeing up liquidity because distributions have, largely dried up from their more mature private equity stakes. And this has actually created opportunity for HarborVest on multiple fronts. The first one I'll highlight is in secondaries. We're seeing really nice discounts on deals within the secondary market, both in buyout as well as venture. And that has provided a nice tailwind to early performance across the program. I mentioned earlier how the secondary performance as of 9/30, 1.3x. So some nice appreciation there. And those discounts I think are still finding an equilibrium. So that's one area that I think we're, us and HarborVest are really constructive on. Maybe dovetailing here a little bit to co-investments. Again, with many limited partners, challenged to free up capital to make, their new private equity commitments in the current year. An opportunity has really emerged for HarborVest to increase their allocations in their share of wallet in some of these more highly coveted co-investment deals alongside top general partners. And so that's actually provided, again, a nice opportunity to, again, increase allocation and share a wallet on some of these higher quality assets. And so that's kind of just a few areas that, again, I think are emerging as pockets of value, given the current market conditions that we're seeing. I think really the punchline here is if you're an LP or a manager like HarborVest with capital to deploy, there are pockets of opportunity that didn't exist, say, 12 to 18 months ago. And I think that all sets up really well for long-term performance. If you take a look back historically at, what were some of the best performing private equity vintage years, you would see that they often coincide with periods of market dislocation, market uncertainty, and really when many investors lean out, that's usually when you want to start to lean in. And so I think that's all to say, really important, as you kind of ramp up and maintain, a private equity program, it's really important to make, those consistent, steady commitments to the asset class, because you simply don't know, which vintage years will perform the best ahead of time. Timing the private markets is nearly impossible, extremely difficult, and really the best way that you're able to ensure that you're in a position to capture, those excess returns offered by the asset class is to really remain fully invested and to remain, long-term and strategically focused. So, on that note, maybe I'll just pause there. That was kind of the conclusion of my prepared remarks for the evening. Happy to, open it up to the group for any additional questions, comments, et cetera, that you might have.
How does it work, right? So let's say we're consistently investing in all the vintages going forward, right? At some point, would there be overlap, or, because it's not being fully deployed in one given year, right? We're in the 2021 vintage or 2022, we didn't deploy all the money, right? So as new deals come on for the next 10 years, 7 to 10 years, how does it get determined which
Yeah.
Goes into what bucket or what fund or vintage?
Yeah, great question. So you're right. With an annual commitment cadence, there is going to be a moderate degree of overlap between consecutive vintages. Very little overlap between non-consecutive vintages within the program. Taking a look at HarborVest's historical, portfolios that they've managed, most notably the Global Fund, which I mentioned earlier, which they've done an annual raise for. We would estimate that overlap to be anywhere in the neighborhood of 20 to 30% between consecutive vintages in any given year. So not incredibly meaningful. I think to put that more into context, I think it's important to kind of understand the level of diversification and scale within any one of these funds. At full maturity, you are going to have exposure to, in the primaries allocation alone, which is about 65% of the portfolio, you're going to have exposure to a roughly 30 to 40 underlying general partners, over 1,000 portfolio companies. Once you factor in secondaries, which are extremely diversified, again, you're looking at, a portfolio all in, well over 2,000-3,000 underlying portfolio companies across the three strategies. And so even with that 20 to 30% overlap, it tends not to be, incredibly meaningful. And especially when you compare that to, say, public market indexes that we have seen become increasingly concentrated, say, over the past 5 to 10 years in, mega cap names and sectors, I think at a rate that we previously had not seen. So hopefully that helps provide some clarity to, what that might look like in any given year. But
Yeah.
Matt, are you still seeing a lot of secondary buyouts? So sales of private equity company assets to other private equity companies?
Yeah, actually that is that definitely is something, a more active area of the market. And again, I think areas where we've seen it the most active is, where that involve higher quality assets. So those A plus rated names. I will say any asset below that, B plus, is largely being held back. And by and large, managers are avoiding auctions right now just due to time constraints, not wanting to take those assets out into the open market, having a more defensive posture. So I think that's one area where, again, certainly has not been as active as we saw probably, and certainly not as in 2021 and not in the earlier part of 2022. One other area of the buyout market that we are seeing, however, higher volume is the take private. So we have seen an elevation in, leverage buyouts of public companies. Certainly the backdrop is relatively favorable there, given the pullback that we have seen in public equity valuations. And so, for example, I mentioned earlier the 3 co-investment deals that are currently pending in the 2021 fund and have yet to be closed. All 3 of those deals are take privates, and so we do anticipate those to close as expected. But that should give you some sense of where else we're seeing some major activity in the buyout space.
One of the subjects we've talked about before in the secondaries is where there's an over-allocation. Plans, public funds, others have had an over-allocation because of that denominator effect. And even to an extent, we've seen it in the town's portfolio where the privates are above allocation because the public markets came down so much. Now it's been decreasing a little bit, but so correct me if I'm not wrong, Matt, but even in like Europe, they're like forced sellers. If you're over-allocated, you have to sell in Europe. That's not in the U.S., but I think that's what I've heard from Matt and team. And if you want to weigh in anything else on that, that's been happening as well.
Yeah, it's a great point, Brian. To that end, regulations in Europe, many European markets are a little bit different in that when asset allocations get too out of policy, they're actually forced to bring those allocations back in line with the policy targets. They're bound by regulation to do that. And so that kind of creates a forced selling dynamic. And that's a really nice backdrop if you're a secondary buyer with capital and looking to be opportunistic. And that's exactly what we have seen HarborVest do in that market. There have been a number of deals come into the pipeline from Europe and that have kind of had that dynamic to it. I think on page, just to highlight a specific one, on page 5, page 6, which is the fund profile. Project Clementine. You'll see it in the largest gains and losses. Project Clementine is one of the biggest gains.
One more. There you go.
And that was perfect. Yep. Project Clementine was a secondary deal that HarborVest was able to secure. Seller was a European pension plan, had to reallocate their asset allocation, and they were able to kind of come in and secure a nice discount on that asset. So,
yeah, that's what triggered all the issues with the pension plans in Europe last year, right? Was it that reallocation? They were just out of whack.
It was a big thing.
Yeah. Okay, any other questions?
Can you go to is there a slide that shows what the different managers are, with what they specialize in the sector, so whether they're secondaries or buyouts?
So not within this slide. Not within this presentation. That is included in the fund annual and semi-annual reports. I think the annual will be coming out pretty soon, but I'm sure maybe Brian, we can work to maybe have that available to the group, and so we can provide that level of detail.
Sure. Thanks, Matt.
Yep.
Bruce Ryan have a question? Was he?
It looks like he wants a presentation, but if we click on that, it says then you will not be able to continue to share.
Bruce, can you hear us? He was out there earlier.
Yeah.
Mm-hmm.
He may have left, but he did, I mean, I can send him.
Yes, I can hear you, and that was a mistake. Don't.
Yeah, okay.
Okay, perfect. Then I'll decline.
Okay.
All right, any other questions for Matt?
That's great.
All right, great job. Thanks, Matt.
Thank you all.
Thank-
Have a great night.
Thank you, Matt.
You too.
All right, so I'll kick it off to the other presentation during the one that just says Town of Fairfield Vanguard. So hopefully that was a helpful, good update from Matt, and, you know, good questions there, but anything else comes up, let us know, and then we could also, later in the year, talk about having HarborVest themselves come in as they've done in previous years. We wanted to give some update. I'll do a quick review of performance, you know, through the first quarter. And I also have some data in there to talk about the pacing program, kind of where things are for the three funds. So before I do that, Doreen, I'll start on page 4.
Actually, you know what? Wait 1 second, I didn't share it.
Not sure.
Is that a right share?
There we go.
There we go.
Before I even get started, one of the things I wanted to say was a thank you, because it's I just realized when I was looking at the performance, it's been 3 years, you know, and it seems like it's gone faster, but, you know, we've had pandemics and everything in there and some up and down markets, but still 3 years is a good milestone, and I've really enjoyed working with the committee and continue to want to work with the committee, and but I just wanted to acknowledge all the work that's been done and all the great interaction. So just say on behalf of myself personally, but also Vanguard, you know, thank you for 3 years. So yeah, that was pretty amazing to see. So I'll just start on page 4. This is the main one I'll hit. I won't hit the other pieces of the deck, but I'll jump right to our performance. You know, I guess the word kind of surprising, we were off to a strong start to the year, despite ongoing talks of a recession later this year and the banking crisis with Silicon Valley Bank and First Republic and Credit Suisse. So what you see here on the left-hand side of the page is both U.S. and international equities doing quite well just through the first quarter. Yes, there's some remainder on a one-year basis, which is the yellow line, still negative on a one-year basis due to the poor results of 2022. But we're off to a good start, and even through the end of last week, the returns have increased as well. So U.S. equities are up 7.6 through last Friday. International equities are now up 8.4. So international is outperforming U.S. again. International did finally outperform U.S. in 2022. And then in the middle of the page of the fixed income, it's positive. If you recall, we came off the worst year in fixed income pretty much ever. But we've seen rates on the medium or the intermediate or longer term come down, like 5 years, 10 years. Those rates have been slowly coming down, and that's why you see positive returns for both U.S. and non-U.S. bonds. Now, the Federal Reserve still controls the very short end of the curve. Now, I always include a slide on that, so we even still think the possibility of another rate hike, but positive performance for fixed income and non-U.S. fixed income. We have both, so for diversification purposes. So that has all contributed to a good start to the year. I'll just jump to page 8 to show you what I mean as far as with respect to the fixed income yield curve. The red line is where we were a year ago. The yellow line is where we are at as of the end of the year, and the green line as of the end of the first quarter. So, of course, last year, rates moved up so sharply. It's kind of the second most aggressive rate hiking plan that we've seen. but then you see that green line slightly below the yellow line in the last 3 months, and that's what's helped contribute to the fixed income positive returns this year. So just going to the next slide. Sorry that the page number doesn't match the PDF number, but this is the plan performance. This is the pension that we have up here first. So in light of what I just said about the year-to-date, so the first 3 months for the town is 4.3% on an absolute basis. And from a fiscal year-to-date, the last 9 months, that's also positive, which is encouraging to see. So positive 4.35% on the fiscal year-to-date. So a few more months to go, and I know after last year's closing with a big negative number, we'd like to see that stay positive. You see the other numbers, but I mentioned that inception to date, in the far right column. You know, so our inception date is March 20. That's when I'm talking about the Vanguard being with you all 3 years. The historical performance is loaded in, but so at least that I don't take any credit for it, but the inception to date for the last 3 years, a strong 9.24 versus the composite benchmark of 8%. Right
Why
below,
is there a lag of so much on that fiscal year and on the 3 months between the actual plan and the composite benchmark? I mean, I would think that those would be pretty close if we're just invested in the market. I know that there's some friction there, but
it's all related to, you know, because of where it have all the indexing, it's just related to the private equity and the private real estate. And then more recently, this is no knock on principle because their long-term performance has been excellent, but more recently they've lagged.
Yeah, okay.
As far as the difference between that and the composite on the short-term basis.
Yeah, I think they talked about that.
Yes, yes.
Okay.
Right below it is the allocation, and this is kind of dovetailing with what we just talked about in the private equity session, but where I'm just holding, for the very last row of private equity, I'm still holding right now the policy in here at 5% because we're, as Matt alluded to, we haven't really committed much to get there. And if I put that 10% policy, it would show things as either vastly underweight or overweight. But if I were just holding a constant at 5, you know, given that there's been so little called capital from HarborVest, you could see that, you know, we're over allocated still with 7.3% from the remaining of Mesereau and Lexington, and even Principal, because of their strong performance, not just this 3 quarters, but private real estate is over that target of about 5%. But we're slowly seeing now the marks come negative for private equity, private real estate, whereas we didn't see that in 2022. So I think allocations are generally in line.
So the private equity of 31 million, that's the stuff that we've actually invested in, not the.
That's
So really only a small sliver, right? It's like that much has been deployed from HarborVest.
From HarborVest standpoint. I think that'll meaningfully change in May, as Matt alluded to, as you'll see a bigger call of, they're estimating right now about 8% of the committed capital. So 8% of that 30 million that was made for the 2021 fund. And I'll show you some interesting data that really does confirm what Matt was talking about the market. So yeah, that's the main performance. You know, the private equity and the private real estate is lagged, so it's still showing values as of December. You know, we won't have the March data, the first quarter data, for another month or two. However, Principal did release this week just kind of a flash report, not official, and they don't have the benchmark data because the Odyssey index hasn't collected everything, but Principal was showing like a negative 3.6% for the first quarter as a preliminary number. So you still see that market locked up. You know, they still have a redemption queue. That redemption queue has decreased, and their inbound queue, which we've talked about, has actually increased. So, but for the most part, there's still not a lot of activity happening in private real estate, and those redemption queues are still out there. I'll go to page 13 of the PDF, And just a recap of how the OPEB plan is doing, you know, it's a slightly different allocation. If you can go back a little bit to, it should be 13 of the PDF at the top of the screen.
At the,
Yeah. Yeah, there we go.
go back up.
Oh, no.
One more.
One more.
One more down.
Down?
Yeah, there
Yeah.
you go.
So stronger numbers for the OPEB plan because it's a slightly more risky profile with more, you know, more equity exposure. And so on a fiscal year to date, 6.73% versus the 7.26. So I just quoted 4.35 for the pension. So you could see the higher returns on an absolute basis coming from the higher equity exposure. And, you know, this fund, if you recall, there's no Lexington, there's no Mesereau, so that dispersion that you were referencing, Jack, is really due to the private real estate because everything else is indexed. So it's a little bit more stark with the OPEB plan. But all the other longer-term performance numbers are really strong, relative, as well as absolute. Before I go into the continuation of the private equity discussion, any just general questions on the market that, you know, I skipped over some of the other slides just in the interest of time, but anything else top of mind? Okay, so interject anytime. Let's go to page 19, Doreen, please. And for those following along, 19. This is the cash flow modeling or the pacing that we're doing, and we update frequently, you know, for that this represents, at least in 2021 and 2022, you see an A next to those numbers, that's actual. You know, everything going forward is what we're projecting as far as redemptions and from calls. But maybe just in continuing our conversation, you see the shaded numbers above the black line, those are the distributions, and those are namely really from our existing private equity partners. But if you look at 2021, we had 11.1 million in distributions, and last year, 2022, we had 5.2 million. So that dovetails exactly what Matt was talking about, the private equity marketplace. So just deal activity is not happening, and therefore you're seeing fewer redemptions. And that's the purpose of doing the pacing program and updating that, because it's just an estimate till things really happen. So this is our forward-looking estimates past 2022 of calls and distributions. And I'm going to go to the next page, which admittedly is an eye chart, but it gives you all the data beyond in there for Legacy or HarborVest. But the number I'll just focus you all on is the very first row. So for 2021, this is for the pension plan, there was 30 million called, committed for 2021 fund. In the 2022 fund, it's 25 million. And when we structured the pacing program for HarborVest, you recall, we increased the allocation to private equity to go from 5% to 10%, and really was to try to get to that 10% allocation within about 5 years. You don't typically want to do it all in 1 year because of that vintage year diversification, but we also don't want to stretch it out too long. And so this is what the pacing looks like. You know, right now we would say for the 2023 fund, there's a commitment in the ballpark of 15 million. So slowly decreasing. You know, we kind of over-allocate in those beginning years and then kind of tail it off. But I went back to look to, again, in light of the market, and so when we first did the commitment back in 2021 and we looked at the projected pacing, it would have had about 20 million going in 2023. But with fewer distributions and trying to model out, you know, that'll adjust what we think would be, you know, the appropriate amount to commit to in 2023. So I just wanted to kind of highlight how in 2023 we're looking at 15 million as an estimate right now, but that was looking at more like 20 million 2 years ago. And then, you know, again, we'll see what other commitments and calls come through here in the next couple of quarters, and update that as we get towards the end of, you know, more of the summer. maybe we'll start to talk about what would the, committee like to make as far as a commitment to the 2023 fund. I did this also for the 2 OPEB plans, where there is no private equity, and, maybe just if I looked at a similar page, on page 23, this is looking at the OPEB employees plan, but looking for, we're say on target for around $1 million, just shy of $1 million commitment, whereas 2021 we did $4 million, 1.8 million commitment in 2022, and you can see that decreasing. So we did the pacing for all 3 plans.
Do you generally keep that ratio kind of the same between the commitments and the calls? Is that, so if the, if you decide that you want to change the commitment, or we decide we want to change the commitment, does the call?
Yeah, it would impact it, right. And so if you went to the next page, I skipped over this one, but I did this for all 3 funds. So this is kind of what it looks like. Each different color is a different vintage year, and, you're slowly building, and that black dotted line is the dollar value that would be equivalent of, say, a 10% allocation. So you're trying to build to and get close to and then maintain a steady allocation. It's hard to do exactly because you never know what calls and commitments are going to be. And you kind of saw that other one, if you went back, this is showing nothing because this is the OPEB plan, but Doreen, if you went back a couple of slides to page 21, you could see this for the pension plan. The gray is really your legacy commitments. So of course those are kind of in runoff because the last commitment was not since 2017. And then the brightly colored lines are the new vintages. And again, slowly trying to build to getting towards that 10% allocation.
And the gap, we didn't have that 10% allocation before, it was lower.
Correct,
Right.
correct, yeah. So yes, to Jared, yes, if you change commitment, would change, what the calls are going to be. They're related. So yeah, those are the prepared remarks I had, just, on performance. Let's hope the markets continue to stay strong into the end of the fiscal year.
And beyond.
And beyond, and just to give you some sense of the pacing, and we could update the model in another quarter or so.
And when they make the call, right, so at some point they're gonna make a larger call, Harvest, so then,
Right.
what's the time frame that we have to send the money in, is it like?
They usually give and this is consistent too with Lexington,
Right,
Zero,
right.
but it's at least 2 weeks, that we have. And so the other 90% of our
I know,
portfolio is
very
liquid, and
liquid,
it's been no problem to raise. We're raising cash every month, putting in trades, as Jared knows, every month for benefit payments. But yes, it's about 2 weeks.
Okay.
Correct, yeah.
So then you just, whoever is over allocated or whatever.
Yeah, we'll go back to that page, that asset allocation page. You see where we're current are versus our targets. At the end of the month, it always shows a higher allocation to cash than we really have. We always raise cash at the very end of the month, a couple days in advance of the payments going out. So the cash is usually close to zero.
Right.
We leave some residual for fees and expenses. But, that's how we'll do. We usually will raise cash in looking at where are we versus policy and where are we going to raise from. And we could raise it from all 4 funds.
Right.
Mm-hmm.
All right, any questions for Brian? Thank you very much.
Thank you.
Okay, and over to you, Jared.
All right. Is Eric Caliber on? Eric, are you on?
Right away.
Yeah, I'm on.
Okay. So I sent my report over to you guys, earlier today, not too long ago. There wasn't a whole lot of activity, so not a whole lot to cover there, but, I figured before I went through that, and that limited activity, I would answer some questions that came up in past meetings. And so I asked Eric to restate his questions just to be sure that I got them right and that I understood what was being asked. So one of the questions, I don't specifically remember this one being asked in a meeting, but one of the questions had to do with a distinction between OPEB trust mandatory versus an OPEB trust discretionary account that's referenced in the collective bargaining agreement. I don't want to spend a lot of time on this because I do think it's really more related to collective bargaining, but at some point in time, there may have been some distinction between the mandatory and discretionary in past collective bargaining agreements. In the current one, it's not really, there's no mandate. It basically treats them the same and gives the town administration the option to do either one, if you know, whether it's coming from the mandatory or discretionary account. And my understanding is, because again, this was all pre-2017, where there was the differentiation in the collective bargaining agreement. There, even at that time, I guess it wasn't actually set up. These different accounts weren't actually created. But I wanted to, I don't want to go into a whole lot because I do think this is more of a collective bargaining issue. And if there are any issues, I would go through that process to make any changes that might be desired. So, Eric, I don't know if you have any other questions about that, but I don't want to spend a lot of time on it because it's collective bargaining.
Understood. Go ahead.
Understood. Go ahead.
So the other question was, and I'm going to answer these because I think they might help to preempt some questions that might come up in the report that I'll do. So weekly or biweekly deductions are being taken out of employees' pay. Those contributions are going into the cash account, meaning the town's cash account. At some future date, the cash is being contributed to a trust. Yep. Where does it reside? In limbo? Why shouldn't the cash be deposited directly into the cash account of the trust? Money in the cash account of the trust would be earning interest, and that interest would be property of the trust, not the town. So this is not, it's more straightforward and I think more understandable in the context of the pension fund. And what I can say is that, and when I go through my report, you'll see this. The employer's contribution happens early in the fiscal year, and we just put the lump sum of what our ADEC is and put it that goes into the fund. What we do with the employee contributions is we kind of wait for those to accumulate and do it about every 6 months that we put those into the trust fund. That's the way it's happened. I guess my only explanation would be not knowing what the thinking was at the time is maybe there's some offset there. Theoretically, we could take the employer's contribution and have that align more with, when we get tax revenue, if we wanted to be real granular about it. But we don't. We put it in up front, so that's actually earning a lot more interest and investment earnings throughout the year. And that's my explanation. That's the best I can do on why it was set up that way, and why it's happening that way, and that we're not putting in the employee contributions on a monthly basis. But it does lead to another question about, I'll wait and I'll address that one in a minute. On the OPEB side, so the OPEB, as we've talked about in the past, and I did reach out to both the our actuary and our auditor about it, just to, you know, confirm that everything's being done properly, and they, both of them said, yes, that's good. Because this one is different than what I think everybody's traditionally used to, in looking at a pension fund, where the money is going into the town's cash and being paid almost on a pay-as-you-go type of basis, and then being reconciled or trued up at the end of the year. So it's not like we're putting the money into the trust fund and then drawing down on that money out of the trust fund like we do with the pension fund. So at the end of each year, there's and after we close the books and confirmed by the auditor, everybody's had a chance to review it, we do the true up, and then whatever the true up tells us, that's what goes into the fund in terms of OPEB, the OPEB investment.
Does Milliman have any guidelines or guidance or best practices on how this works going across many different towns and plans?
It's a great question, and I did, we started having conversations with them about treating this like the pension fund and maybe moving to that model. And they said, we're good, like as far as, you know, the assets that we have in there, the size of the fund, we could do that. And I think we're ready from that standpoint to start moving in that direction. The thing that we're dealing with now is more of an administrative constraint. You heard from Megan, there's a lot going on right now. And so and would want this to align with the beginning of a fiscal year.
Yeah.
So to think that we could do it by July 1st this year, wouldn't be practical. But I think, you know, based on what I've heard so far, you know, I think that may be a realistic thing to do for next year, for July 2024, and start it then. And that way, it'll be more understandable for everybody, because, you know, we're all used to seeing things done the way that the model that we have for the pension fund, and looking at things in those terms. So, you know, that's the way I'm seeing things now. I think that would probably would definitely have to be approved by the board to make that transition. And, you know, we can talk about that in the future, and I want to confirm with you know, with my team and with Megan, and make sure that it's doable from our standpoint on an administrative basis to do it, you know, 15 months from now or so, before we give any kind of commitment. But, you know, right now I think that could be done. So there wouldn't be, you know, we wouldn't have to have this discussion every quarter or so, as far as how this works and whether or not it's copacetic, and so that's the plan there.
I'm not sure I'm completely following, but let me just ask you a related question. I'm reflecting on the COLA mistake that was made and how we had to reimburse. If hypothetically interest rates were to rise quite a bit, is there some risk that the employee contributions would be otherwise earning a lot of interest income, and the town is instead earning the income, and then we'd have to have an adjustment of some sort down the road?
That was Eric's question.
Yeah, so
That was Eric's question, okay.
because it doesn't...
Right now it seems de minimis, though.
Yeah, and based on our conversations with the auditor and actuary, they don't get that granular about when these contributions need to be made. So if, you know, even though the, you know, employee contributions may be done on a monthly basis, doesn't mean that they have to, you know, that they have to go in on a monthly.
I think I followed it before, but I'm just saying Milliman's comfortable now. I'm just wondering if rates were to skyrocket. I mean, we've all lived through, you know, different interest rate cycles. Hypothetically, if rates were at, you know, 20, we had Volcker type rates again, then right now Milliman might say it doesn't matter, everybody's doing it this way, don't worry about it. I'm just thinking if things were to go haywire, then we've got backtracking.
I would look at this as a long-term, you know, a long-term model, and this is just my opinion. because it is long-term. I'm not sure what would, unless it were something really dramatic or catastrophic, that the, you know, what was happening at that time would lead us to do something different than we would otherwise do.
Okay.
That's my opinion. I don't know if anybody else has thoughts on that, whether that would be, you know, I wouldn't think that it would make much of a difference doing it in, 24 versus 25, depending on what the situation was at that particular time. But, you know, that's something that we can certainly ask them, and obviously talk to you guys about too. Did that
So
answer
it sounds
your
like
question?
it's on the radar, and if Brian comes in one day and says, oh my God, you know, the official Vanguard forecast is dire, rates are going north in a big way, I mean, it's on the radar, so, you know, you could accelerate.
Yeah,
If need be.
So I don't know if it, I think for all intents and purposes, it would have to align with the fiscal year when we make this change, for practical purposes, so, you know, you're looking at either doing it in July of 24 or July of 25, I guess. So I don't think there's really any kind of in-between there.
Going back to that employee contribution, you said we're doing it twice a year. Why not monthly or quarterly, right? These are employees' monies, right? They're having to take out a paycheck. From a internal control, that's a weakness, you know, that's exposure, right? Not that, you know, obviously we're on the hook, the town's on the hook. Something ever happens, that money, you know, we're gonna pay for it, we got it, plenty of money, but.
What do you,
I mean,
when you say it's a weakness or
Oh, it is.
an exposure there, how do
No, it's people's money, their paycheck, right? Look at your
Yeah.
paycheck, you're assuming that you're having your contributions made into a plan, into a trust.
Mm-hmm.
And the town is holding it for 6 months. Versus,
Eric, on that, if I could add, I mean, because we're AAA and rates are so low,
well, internal control process.
But it's
Wire it. Why are we wiring it?
And so because you know, we're doing this on a cash, it's a cash basis, so as the contributions are coming in, whether it's the town or employees, it's going out, you know, at the same time, so, I guess I don't view it the same way.
I view it this way.
I don't
No, I
see it the same way.
think it should be employee money, right? Town employee, the big number, we could adjust that. We could say, okay, we're putting this year, we're putting it in September, we're going to do 12 months, we always can change that. We have a fiduciary responsibility for the employees. We're taking their money, put it into the fund.
So,
You know, I can't stand
Eric,
waiting long.
Eric Caliper here. The reason why I raised the issue was because the town was doing this with a different investment account earlier. They were doing it with the 457 plan, where employees were getting donations, getting money taken out of their paycheck, but the town was only making the contribution to the 457 plan on a quarterly basis. So they were losing investment. And the way that it looks on the cash flow is it's an off-journal interest, like there's nothing being reported. So that's the reason why I raised the issue. I think it is important because I think it's money that should be invested, whether it's in the cash fund earning interest or whether it's actually working on the markets. And as far as the town making the contributions, they're typically not made early. If I remember correctly from the past cash flow, there haven't been contributions made early in the year. They've been towards either the latter half of the year or the end of the year. So that's not working capital. So that's why I raised the issue, and I just want to make sure that we're doing the right thing here.
Well, when you say the right thing, what do you mean by that?
That the contributions are earning interest when they're being made.
Okay, so I mean, I can go back and see, you know, what's involved in that, and we can look at it. Again, I think I don't know. This is how it's been done for a long time. I'm not sure it's been questioned before. And I suspect the rationale was that we're putting in the employer's contribution early, a lump sum that is way more, multiples more than what the employee contributions are equal to. And, whereas we could do that differently, and we could spread that out. We could spread out the employer's contribution.
So they actually would say, put it up front. Actually, it's been saying, put it up front, you get better returns. Generate this employee.
Well, and
I'm just saying
they'll
for the
factor that
employee,
into their,
the
they'll
employee.
factor that into their evaluation.
I'm saying for the employee, put the money in, whether it's monthly, you're calculating it, you have different variables. Are you calculating it at a 6-month period, or it should be calculated every paycheck? Because there's gonna be various numbers, right? Because you have employees that are hourly, you have salary is easy, divide it up, but, so it'll catch any problems early on. If somebody's calculating on every paycheck or every monthly, and if there's any issues, you're catching it. And it's a small difference, we overfunded somebody.
Yeah, and the other question that I had too, the other question I had too was, and it's a little bit different with the police fire because our contributions are post-tax, but with the town employees, their contributions are pre-tax. So I believe there's some IRS ramifications by taking the money out and not putting it directly in the trust.
No, there aren't.
We have a written opinion on that?
We've had this conversation. I've talked to the auditor, talked to the actuary. Everything that we're doing is fine. I think what you're talking about is the timing of this. And really from a legality standpoint, the issue has more to do with the purpose. And the purpose is clear, that money is being used as their contributions into whether it's pension or OPEB, is going toward that. Not an issue with the IRS.
Okay. Can we get Cohen to give an opinion on that?
I mean, I've talked to the auditor and the actuary who deal with this in more detail than he does, and I would think that if there were any issues that would have come up in an audit report.
Would it be helpful just to get an email from the actuary or someone just stating that?
Sure, I can.
Maybe that's just the path of least resistance.
Yep.
Agreed.
Yeah, I can have them put something in writing.
All right, so you still, you have more on there?
Sorry for the background.
I think,
Sorry
yeah,
for the
no, I
background
can-
noise, and that might. Sorry for the background noise, and that my daughter's lacrosse game in the rain. But I really appreciate at least getting a written opinion on that, and at least addressing the timing issue. I really do appreciate the board's inquiry into it and making sure that we're square on that, especially when it comes to cash flow.
Or just change the policy. We can change the policy. Make it consistent, make it up sooner. Then we'll save money on the lawyer fees that we're gonna be paying. We'll get the money into the accounts. Nobody's gonna raise the question, okay, make a monthly wire transfer.
Yeah.
You get it, this is how it's done in the past, and going forward, we're doing it differently. We're making it better, making it stronger. And that's and the money's in the account, nobody can say, this money wasn't deployed. And even, I know it's not out of our purview, but on a 457, this is a 6 month on both what's doing on our pension plan and the 457, even though they're two different things for that 6 months. So that's other people's money. That's a different animal. So if you have it consistently, okay, pulling the money out every week or every paycheck, transfer it over.
Yeah.
Transfer it to everything else that people have to vote in. And it eliminates any noise down the road and makes it get the recorder on a monthly basis, that if we ran a trial balance on a monthly basis, you would have this number in there versus, oh, missing.
Yeah, so let me look into it.
Okay, thanks.
Yeah. Okay, so moving on to my report, that should be in that folder.
Folder. Oh, no, the folder's gone. Oh, I might not have stopped sharing. I think I did. Mm-mm.
Go back to the WebEx. See if it's still sharing in there.
Thought I stopped sharing.
No,
And now the folders.
where's the folder?
That's weird. That is strange.
Is it behind that WebEx? No.
Let me close it out. Maybe. Yeah,
No, can you click on the bottom left there?
this?
Yeah. And go to the File Explorer. It's in the background now, yeah. And then just go to the D, I think it's the D drive. Yeah, go to the D drive. Yeah,
This
go
one.
ahead. Yeah.
There you go.
I think I put it in there, right? All right, maybe I didn't put it in there. So let me, if you pull that, can you pull that drive out of there real quick?
Yep.
We can do this quickly.
I know what everyone's thinking, the Bruins game is on, but we're getting there, all right?
All right, now throw that back in, and it should show up there.
Well, we're 6-6 at Swarthmore, so.
Okay. See the CFO report?
Yes.
Yep. Is it the one all the way to the right there? Is that it? Yep. Maybe just expand, blow that up a little bit.
Mm-hmm.
All right. So, as I mentioned, there wasn't a whole lot of activity in the, either pension or OPEB, other than the, transfers related to the benefits in and out. We did, again, consistent with last year, the employee contributions, were added into the, for the, town employee pension. You can scroll down there.
Mm-hmm.
Secretarial fees. So I'm looking, just so everybody, I'm looking at the, second column from the left. From the right. That's the third quarter. Yeah, so not a lot of differences there. So go ahead and scroll down.
Mm-hmm.
And this is the, police and fire, and again, the employee contributions went in the third quarter. And typical transfers in and out to cover the benefits. And you can keep scrolling down. And then we've got, the consultant and actuarial fees. That was, those are Milliman fees. And you can scroll down to OPEB on the next page. So the employer contributions, as I mentioned, those are, they actually went in, I believe it was 2 weeks ago, that the employer contributed, so it's not gonna be covered here because it was in the, outside of the quarter, but they did go in just to give you a little preview. You can keep scrolling down there. And next one. And, you know, same thing here. There was, not a lot of activity. And the same thing with the employer contribution when it happened in April.
So the OPEB contribution goes later in the year, right? Saying it's going in April, and the pension money contribution employer is in the beginning of the year, right?
Yeah, because of the different models that we're following.
Okay.
Because we have to wait till that true-up happens, and it's, you know, confirmed by the auditor.
Oh, okay.
And the audit report is confirmed and everything, so, yeah. So there's a lag there. There's definitely a lag.
So it's not, you know, town approves the budget, there's a number, whatever dollar amount for OPEB, dollar amount contribution for pension. So when we know the dollar amount?
No.
Not for employer contribution?
No, because we have to look at, claims and all of that.
Okay.
That will offset it, and those will vary from year to year. That's why it does, and I understand the confusion about it, and that it gets complicated, which is why I think it's probably best for us to start looking toward going to you know, the pension model that we've been using, so, you know, it's in a model that everybody is used to seeing and understandable. So.
All right, is that it?
That's it. Yep, that's it.
Okay, moving on, any old business to discuss? Any new business anyone wants to discuss? Could I have a motion to adjourn?
Make a motion to adjourn.
All right, we got one, we got two. All right, all in favor? Yeah, all right, okay, we're done.
All right.